All right, everybody, let's go ahead and get started. As I was saying just before a few more people joined in, what I would like to do is cover long calls today. So it will be, if you're familiar with options, this will be probably a review, but hopefully as we maybe look into the option chain, we start to spark a dialogue about how to strategize risk management, as well as profit triggers, looking at the option chain and really understanding the option chain itself, as opposed to only jumping into the risk profile. So I'm going to do more work with the option chain, less work with the risk profile. And every so often, I'm going to try to pause and give people an opportunity to ask questions. But I will ask you to hold questions for certain sections, just so that I can get through a few ideas and then move us forward. I'm starting on this screen today that's showing all of Suzanne's rooms. And I think it's a really great place to start, because when you talk about studying with Suzanne, I think that the incredible benefits of studying with Suzanne are just her willingness to teach what, for me, even a year ago, felt very intimidating. Advanced option spreads where you're buying this strike, you're selling that strike, you're doing it at sometimes different expirations. And she teaches you step by step how to do all of these things. But day like today, we're not talking about spreads. We're simply talking about the fundamentals of a long call. And the truth is, if we can really understand to a degree of specificity what is happening with each individual leg of an option spread, it becomes a lot less intimidating. So I can remember at one point, Suzanne was talking about how you need to understand calls or puts as building blocks of a greater structure. And the first time she said that, even that made me feel intimidated. And now I do feel some pride that I really do know what she means when she says that. And so hopefully today we can really jump into the discussion of the building block, so that as we get through these more complicated rooms, the butterfly room, the peacock room, and she starts throwing challenging spreads at us, we don't feel intimidated by them. Instead, we feel confident. So that's what today's focus is going to be on. As always, we have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. All right, long calls. The purpose of a long call is to buy to open. You'll see that in the chat a lot, BTO. A call based on a technical thesis that the price of the underlying is increasing significantly beyond the current price. The underlying is the equity, index, or instrument being analyzed for price action. Today, we will be looking at SPY's chart, and we'll also be looking at some screenshots that I took of SPY's option chain earlier this week. So the underlying that we're going to discuss is SPY, and we will be talking about SPY in relationship to buying calls. If you were going to buy a call, the market landscape you would be thinking about is an expected rise in volatility. So you want to buy when you think volatility is at least neutral, and anticipate a rise in volatility. I'm not going to talk a ton about volatility today. I will talk more about delta and theta, but we will touch a little bit on volatility. You might expect a market catalyst or have a technical bias towards a significant directional price movement in the underlying. Today, when we talk about our SPY example, I'm going to make it just a very simple chart-based technical bias that might have caused the trader to want to trade SPY and go long by purchasing a long call on SPY. All right. Catalyst, of course, in the market can be anything that leads to a drastic change in stock's current price trend. And a technical bias may be a chart pattern, for example. So here we're looking at a screenshot I took. I wish I took the screenshot over the weekend. I didn't. I took it yesterday. But this is the monthly chart for SPY. And so you can see that what I have highlighted is just a monthly consolidation. So we notice that price ran up from this level, creating all-time highs. We've been sort of zigzag trading back towards it. But one of the things that Suzanne likes to teach in terms of technicals is when we see a level where price is trading sideways, it should provide support. So where price was sort of chopping around for a couple of months, when we visited this on last month's bar, that could have been a reason for us to think, okay, let's consider a long position. And so now the next slide I have is going to show SPY on the daily. Oh, no, it's not. I'm just sorry, I forgot my order. I will be jumping into SPY on the daily. Before that, let's talk a little bit more about the contracts. When you buy a long call option, the investor is securing the right but not the obligation to buy 100 shares of the selected underlying. So that means that when you select your long call, you're determining a price that you have the right to purchase those shares of at expiration. Generally, traders do not choose to actually buy the shares. We choose to instead buy the long call contract, watch that contract hopefully inflate in our direction, and then sell that contract. If we hold the contract until it actually expires, then we will be long the 100 shares. That absolutely will happen. They will be automatically exercised if it's in the money. But we can close or open these contracts at any time. All right, so it's 100 shares of the selected underlying at the strike price chosen. And it can be any time before market close on the expiration date. Contracts can be closed after being opened. And so we would buy to open, BTO, and then the abbreviation is BTC, meaning that we buy back that, I'm sorry, I should say STC, sell to close that. So that's a misprint by me. I put that in. It should say STC there, sell to close. When you purchase this call, the investor has planned a rational practiced exit strategy for capturing profits and an exit plan to avoid or minimize losses. And so now we're going to talk about this daily chart of SPY. And let's pretend like we don't see these three candles. Again, this was a screenshot that I took last night after market close. And instead, let's just pretend that we were thinking about SPY from Friday's close. So this candle right here was Friday's close. You can see that it traded into monthly support. And that's where, as we're making our trading plan on the weekend, we might be thinking about going long on SPY. And so what I tried to draw in was just a simple trading strategy that we could have considered going long. And it centers and frames around Friday's candle, where if we think that that monthly support that we spoke of earlier was going to be enough to cause a reversal, then we might have considered buying a long call on SPY when SPY was trading at 361.80, that's the top of this candle, and setting our stop to the bottom of this candle, 357.18. So that's about, let's just say, roughly $4 of risk. And then targeting the close of this gap. Clearly, Tuesday gave us a lot more than that. But if we were looking at this on the weekend, we might just think, okay, this candle could be our risk. The close of this gap could be what we're aiming for. And up at 374.22, that's about $13 of reward. So obviously, traders could simply buy shares of SPY, but when you buy a long call option, you can maximize your potential profits a lot easier by using the leverage of options. So we're going to talk more about that, but I will be referring to this slide as we go forward in the presentation, just so that we can understand how to strategize not only a target, but also, in case we were wrong, how we could plan for a loss. All right. And so back to the fundamentals, the options contract stipulates which party has the right or obligation to buy or sell an underlying at an agreed price before a specified time. They are leveraged tokens. Option spreads are wholesaling or layering contracts. So when we talked about at the very beginning of the class, how Suzanne likes to teach us how to create option spreads, that involves layering contracts. All right. Pricing is based on a mathematical formula relating to the movement of the underlying. That means when we talk about movement of the underlying, that is talking about if price is going higher on SPY, for example, or if price is going lower, that's going to affect the cost of the contract. It offers exposure to higher value underlyings, provides diversification potential, and gives access to trading volatility and gamma. We'll talk a little bit about gamma, and like I said, a little bit more about volatility. So this is the risk profile of a long call. The first time I saw a risk profile when I was trying to learn about options, this graph would just drive me crazy. It was really hard for me to get my head around price down here on the bottom, because I was so used to seeing time down at the bottom of my candlestick charts. But you get used to watching these, all right? And basically, whenever you want to purchase a call or a put or any type of spread, you can pull up a risk profile and start to see how the price change of an underlying will affect your option contract. So the goal is to try to enter a long call at a time when price of your underlying is going to go higher, and that is going to make the profit potential increase. So you want to exit when it's relatively less expensive. You want to enter when it's relatively less expensive. You want to exit when it's more expensive. The break-even price is going to change day by day, because the closer that an option gets to expiration, theta is going to start to eat away at the value of that contract. So when you enter your long call, you have to keep in mind that at expiration, whatever cost you paid to enter, you need to add that to the cost that the underlying was trading at the time that you entered. So whatever that cost is that the underlying was trading at, you add the actual cost that you paid to get into the option. And that's where you need that underlying to be trading at expiration in order for you to break even. If it's trading above that, you will make money. If it's trading below that, you'll lose money. We'll talk more about this as presentation continues. Right, a call debit becomes a loss if it stays below the break even. The break even point is only relevant to those aiming to exercise the position. And so, like I said at the very beginning, I do want to repeat this a few times, because truth be told, I forgot this when I was trading butterflies like 6 months ago. And I let a butterfly expire, and all that I was really worried about were my short strikes. And I knew that my short strikes were not going to expire in the money, so I wasn't worried about it. But I had a long that was in the money, and I ended up accidentally being assigned 100 shares. And it happened over the weekend, and it caused me a lot of stress. I was able to escape that trade with an accidental win because I got a gap in my favor before Monday's trade, but it was just dumb luck, because I forgot the simple reality that a long call will automatically assign you 100 shares, which my account was not structured to hold. Like I was gonna get a margin call if I didn't exit that. So I want to not intimidate anybody, but it is a kind of a silly story to me. Like I was really stressed for a whole weekend. It worked out in my favor, but you want to make sure that you close these unless you really plan on holding 100 shares. All right. So this is one of my favorite graphics that Suzanne has shared. No one talks about Vama, Vana, Veda, Charm. Suzanne teaches how not only the basic Greeks, but how the Greeks interact with each other. Today, the main focus that we are going to be on is delta. We will also talk about time. We'll talk a little bit volatility. You will see, especially if you're in the Telegram groups and you're active in the groups, you will see Vana gets talked about a lot. Charm gets talked about a lot. We're not going to be covering those things today. But we want to make sure that we understand long positions make money when price makes a strong directional move. Price moves efficiently in one direction. Volatility increases between time of purchase and sale, and there is sufficient time on the contract. So like I referred to earlier, if we buy that contract and we don't pay for enough time at the onset, then theta is actually going to start to work against us. And I'm going to show everybody how that looks on the option chain. All right. So the option Greeks benefits, delta increases as price moves deeper in the money. So if price goes in your favor, you enter that SPY position and price goes higher, your delta is going to increase and put your option contract deeper in the money and inflate your premium. The premium is the cost of the contract. So you want to buy at a low premium and let delta increase the cost of it for you. Volatility increase also adds to long options values. Right at the beginning of trade, so right at 9:30 a.m. Eastern, volatility is going to be high. That's sometimes a bonus time to sell. If you want to get out of a position, it's sometimes really beneficial to sell right at the open and capitalize on that volatility increase. Sometimes we want to be careful not to buy right at the open, because sometimes it's difficult to know, first of all, which way price wants to go, but also because we will be paying a premium for that volatility. Gamma is positive when at or near the money. Gamma, I like to think of as delta's delta. Gamma is delta's multiplier, and we will talk a little bit of gamma today. Big risk is theta decay. If I buy a share or shares of SPY, theta is never going to be an option. If I buy, theta is never going to be a factor. If I buy a call of SPY, from the moment I purchase that call, theta is going to start to eat value off of that option. Volatility crush, part of the option's value is volatility. So when volatility is present, the investor pays a higher premium. If volatility drops faster than the value of the underlying, this can make it impossible for the options contract to be profitable. So the risk is, especially you buy too close to earnings when volatility is super high, or if you buy right at the open when volatility is super high, price could actually move in your favor, but you paid so much for volatility that when that volatility drains out of the contract, then you still can't exit for a profit. So it's something that you have to be aware of. All right, let's talk a little bit more about delta. The ratio of ownership you have to the underlying. What that means is when we look in the options chain, we'll see that deltas actually change. So a call right at the money is normally going to be about a 50 delta. And that can, basically it will behave as if you own 50 shares of the stock. If SPY goes up by $1, then that contract is going to appreciate by $50. If it goes down, depreciates by $50. You get deeper into the money, it'll be more like an 80, 90. And so, it works the same exact way. So at expiration, your contract is going to be worth, or you're going to be on the hook for 100 shares. But as it's trading, it's really not trading like 100 shares. It's trading like whatever Delta says it's trading like. So Delta tells you how many shares it's really behaving like. The 20 Delta, for example, gives us 20% exposure to the 100 shares of the underlying. It can be stated also, and I love this, as a percent chance of being in or out of the money at expiration. So Delta is giving you an implied probability of your trade being successful. So if you buy deep in the money, you buy at an 80 Delta or a 90 Delta, they're telling you that not based off of any technicals in the chart, but based off of the way that the option chain is trading, they're saying that you have a statistical 80 to 90% probability of it going in your favor. However, by that 20 Delta, then it's a much less likely proposition. The greater the Delta, the more your option fluctuates like a buy and hold position. Delta over 70 loses gamma exposure and begins to lose the leveraged aspect. One of the things that Suzanne is super artful about is buying an option just before the gamma explodes and turns, say, 50 or 60 Delta into an 80 or 90 Delta. And it's an art to that. And so understanding these little details is going to be super helpful for the future. Gamma is the rate of change, which is the acceleration of Delta for every dollar the underlying moves. And it is the highest at the current price. And it increases rapidly when time is decaying. Before I jump into this option chain, I would actually like to take a quick pause because I feel like I've been talking for a very long time. If there's anything that I just went over that feels like it's going over anybody's head or just anything that someone would like clarification on, I'd like to pause and give opportunity for questions. It'll take a few minutes and then we'll get right back into the planned presentation.
Jay, on the last slide, there was I've been taking notes, so there was a statement about gamma, but I missed that one.
Got it.
Go back one, that would be great. Thank you.
Oh, I'm actually.
Or not.
I'm trying to go. I'm like, well, no, I'm going to go back. Give me 1 second. Not sure why it wouldn't let me go down or wouldn't let me go back.
Okay, thank you very much.
Sure. So you're saying I just went a little bit too fast here?
No, I'm writing too slowly.
So gamma is the rate of change. It's the acceleration of Delta for every dollar the underlying moves. And it's highest at current price. When we get into the option chain, I'll actually point out some things about gamma that should make it feel a little bit more clear. It basically, what gamma does is it sort of shows you how a strike price, like whatever given strike price you select, it shows you how fast that strike price's Delta should change if price of the underlying changes. That's the way I like to think about gamma. So it's great when it's working for you. It is not fun when it's working against you.
Thank you.
Absolutely.
And I know that as we see it on the options chain, it'll definitely make more sense, you know, for those of us who are like getting a lot of terms and things. Just wanted to.
Got it.
Yeah.
Cool. Thank you. Okay. This is actually a screenshot that I took. I tried to take it as close to the open on Monday as I could of SPY. And so you'll notice I have boxes for 3 different contracts. This is a screen that I want to spend a little bit of time on because for me personally, when I first started trading options, even before I clicked into the option chain itself, this screen just used to give me so much anxiety because it just felt like an information overload. And so I hope that if anybody else feels that way when they look at screens like this, I hope I can sort of share some of the ways that I think about it so that it becomes a little bit less intimidating, because this screen can really teach us so much about theta, especially, and a little bit about it teaches us a lot about vega as well. So all we have here is a big long list from the top to the bottom of expiration dates on options contracts. So we all know, if we've traded a contract before, this is a slide, so I can't click it, but if I click on any one of these, it's going to open up an option chain that gives me a multitude of strike prices. But if we compare the expiration dates, then we can actually see exactly how theta works and how we should anticipate theta to work. So I highlighted 3 different expiration dates. Again, this was taken on Monday. So I went with October the 10th. I went with November the 2nd, and I went with December 16th. Actually, I think I put this box wrong. I should have went with October the 7th. And I think if we go into the chain, like the next pictures I took were actually for the 7th, but I think I just actually put this box wrong. So I apologize. Let's see what I did there. If I can go, what did I, there we go. Yep, there we go. So this is actually, if we were looking at Monday, and again, this is from the markets open. I've got a few prices selected that I want to talk about. And this is as close to the market open as possible. I'm going to try to jump back to this daily slide. So I'll kind of bounce back and forth from this slide to the option chain. And so this is about right as this candle is opening. We're underneath maybe what our trigger would be to get into the trade. Obviously, we're not at the low of the day. We're not perfect, but we're right at the open. And we're thinking, okay, price is trading close to 361. This week, I would like to try to target 374. If things don't go my way, I will exit the trade if price is trading at 357, okay? So now I'm gonna try to jump back into that first option trade chain. So at the top of the chain, you can actually see where SPY is trading at. So SPY is trading at about 361.15. And so that means that the 360 strike is in the money. It's beneath the cost that SPY is trading at. If I were to buy this contract, I would click on the ask, and I would pay $6.08 for it. That is option contract speak. When I first started trading options, I really didn't want to embrace that. I wanted to constantly just change it to like, oh, that's $608, which is true. You have to know that when you're trading options, you always multiply by 100. So this contract does not cost $6.08. It costs $608. It's also important to let your mind, I should say it like this. It's important not to resist letting yourself talk in terms of options contracts. Still know that it's $608, but think about it in the right terms, in terms of $6.08, because when we start to talk about the Greeks are going to be in terms of options terminology as well. And it's way easier to just do the options math this way and then multiply back at the end than it is to say like, oh gosh, $54, gamma's $3. No, don't do that. It's 54 cents, 3 cents. Theta is going to eat at 68 cents a day. That means that tomorrow, from the time that this screenshot is taken, if SPY was trading at 361.15, 24 hours from when this shot is taken, then we'd have to take 68 cents off of the cost of this contract. 68 cents would be gone from it. It would be worth less because we're that close to expiration. So the first thing to think about is always thinking about these contracts in terms of the actual options terminology. It's really helpful. The second thing that I want to point out about the options chain is, if you remember, we were trying to make about $13 of price movement on SPY. We were trying to see price increase by $13. An easy way to estimate where a given contract will be is to simply imagine moving $13 backwards in the option chain. And the reason that that works is, it will, if you buy, for example, an at the money option, we're just going to call it 360 for the purposes of this explanation. An at the money option is about $6.08. If price goes $13 in the money, meaning price moves up the chart $13 in your favor, all you have to do is look up the option chain $13 from where you got in to see roughly where that trade should be working for you. So we can just go $13 back to, I'm sorry, $10 back to 350, another $3 back. And you can see that's giving us a really close estimation. It's about a little bit over, it's about $9.50 roughly of profit that you should be expecting to make if SPY makes that move. And that's calculating the combination of delta and gamma. Notice that the delta on this option is 54. The gamma is 3 cents. And if we just go one strike higher, or one strike lower, excuse me, you can see that gamma has been added to the delta every time. We added 3 gamma to this delta, 54 turned into 57. We keep adding 3, so you can see it right here in the chain. 57 adds to 60, 60 adds to 63. So as price is moving in our favor, we're continuing to get this bonus, this boost of gamma. For every single dollar, it's actually accelerating our profits for us. And that's the reason that you see this type of profit. So it's just something that, without even looking at an analyze tab, if you look into this chain, you can start to see and familiarize yourself with, oh, if I'm trying to make $13 on SPY, this is the reasonable profit that I should get. You can do the exact same thing when you start to try to calculate your risk. We talked in that chart example that we were looking at about a $4 risk. So we could just simply count up $4 to 364. And we would see that what we're risking is roughly $2. So what's nice about looking at this on an option chain, in my opinion, is it starts to lay out for you exactly what your risk to reward is. Notice that it's different. It's a different ratio than what you get simply by looking at the chart. And that's because delta and gamma fluctuates as you get deeper in the money or further away from the money. Notice that as we get higher and further away from current price, delta actually shrinks. And that's actually really helpful for us, because if price goes against us, it means that we're getting hurt less than we would because the delta is actually slowly diminishing. And so I just think that that's an important thing to think about, an important thing to realize when we're trading calls. You still have to have an understanding of, well, you know, if price goes against me, I could get burned. But it helps you to gather your thoughts and understand what are you really risking. All right. So that's one point I wanted to make, just in terms of how the Greeks interact with each other. On the next slide, we're going to talk about this same trade, but selecting a further out expiration. And so I'm going to try to kind of bounce back and forth to show the difference of the contracts and also show the difference of the theta. So notice this theta being 68 pardon me, that's a extremely aggressive theta. It's only 4 days out from expiration. Obviously, if you would have taken this trade on Monday, the trade would have worked out for you just fine, even with a theta like that, because we got such an incredible, I mean, this gap that we got on Tuesday was just absurd, and it ran right to us. It would be hard for me to take a trade like that with a theta that high, because it's hard for me personally. I did not anticipate, even with the big bullish day that we had on Monday, I woke up surprised that price gave us this much overnight. And then when it gave us that much overnight, just continued to rocket. That surprised me. When we got that much overnight, I actually thought it was just going to relax for the rest of the day. I didn't think it was going to keep on flying. So when you trade options, you want to make sure that you account for the fact that it could take you longer than this extreme example to get to where you're trying to go. And so with that being said, this is imagining that from that original option chain, instead of selecting 4 days to expiration, you select 30 days to expiration. Notice that delta at the money is pretty much the same, but theta is hurting you way less. It's hurting you 20 cents or $20 a day, as opposed to 68. So that's already a lot more manageable. You may choose and decide that it's not, that you want something better, but that's already going to work a lot more in your favor. Notice that the cost of the contract is twice as much. It's twice as much 30 days out as it is 4 days out. So you're actually paying a higher premium to keep theta at bay. You're paying a higher premium, but in terms of what you were planning to do on the chart, you'll see that you're going to come out in a very similar way. Also notice gamma is actually smaller right now than it was in our first contract. And so that means if we count backwards, we started at 3. I have this, people, I apologize for my boxes. My boxes are all over the place today. I'm a little embarrassed. Let's keep the box at 360. All right. And let's suppose actually that there is no strike for 347. So let's just take us down to 346. And you can see 346 actually gets us from 1277 to 2234. So it's pretty close. It's almost 1,000, but not quite. The profit target that you would be aiming for by putting up more capital, $12.70 versus I believe $6.08. You're still going to make the same reward if price gets to where you're trying to get to. It's just that you're less worried about theta eating your profits while you're waiting for that price to make its way up. And obviously, if you start at 360, you go up to 364, you'd be losing roughly the same amount of money. So 1277 minus 1053, about $2.24. So you're losing about the same. Your risk to reward is about the same. However, the benefit of paying for a little bit more time is it allows your trade to breathe a little bit. And so then if we go forward in time some more, we choose 74 days out. Notice that you actually, the rate that you have to pay isn't quite as high. Like we did not double the cost of this at the money contract, because that would be more like 24, close to $25. And I'm going to pause for a second. Go ahead, Vicky.
I just have a question, because you're looking at SPY, which is an ETF, and do you have the same rule for if you're trading stocks, or is there a general rule you're saying, okay, I'm looking at 34, do you have a certain limit that is your sweet spot, or 30 days, I'm sorry. How do you determine that?
No, absolutely. So let's just go back to the SPY chart and we'll talk about that. So I want to get back to first. I'll kind of answer. It's not exactly the question you asked, but I want to tell you why I chose SPY. I chose SPY because yes, it's an ETF, but important to me is it's essentially the S&P 500. So when I first started trading, a huge mental barrier for me was understanding market momentum. Like I really struggled with that. And so the way that I attacked that weakness in my trading was to work really hard to study the S&P 500. And so SPY is one way to express a thesis on the S&P 500, on the market itself. If you want to be a futures trader, then you trade the ES, which would also be a way to express a thesis on market momentum. And so first and foremost, the reason that I chose it was because of that. Now, to answer your question, depending on, if you're trading a stock, if you're trading an ETF, if you're trading spreads maybe on the S&P 500 itself, I think generally a rule of thumb should be, and this is what's the way that Suzanne teaches it. You want to, if you're doing a long call or a long put, you want to pay for twice as much time as you think you need for the trade. So if you plan on being in the trade for a week, you want to pay for at least 2 weeks. If you think that the trade is going to take longer to develop, if it's going to take a month, you want to pay for at least 2 months. I also feel like I'd be remiss to say, I do not trade long calls by themselves. I don't trade long calls or long puts. I'm always in the spread. So probably 90% of what I trade are butterflies. But to understand a butterfly, you want to really have a good understanding of these building blocks. Brief digression. When I trade butterflies, time is working in my favor. It's not working against me. And so because of that, I don't like to be in a butterfly longer than 2 weeks. So normally it'll be like the longest I'll be in a butterfly would be maybe a Tuesday or Wednesday, targeting the following Friday's expiration. But I actually generally like to go even closer. Like I normally like to just say like, oh, I think we'll be up here in 3 or 4 days, and then do a butterfly there. I'm digressing. I'm not going to talk much about butterflies, but I do think it's important to say, like, actually, in this presentation, I'm going to teach about calls and the best practices with calls. But in terms of my experience, I like to trade butterfly spreads. Does that answer the question?
It does. Thank you. Yeah, I tend to trade SPX as well, but yeah, I was just curious about the time. If sometimes some traders will give a specific sort of generalization of how much time to be in it, but I like how you explained it. That made sense. Thank you.
Absolutely. I will say, like, another thing just to think about, on that topic is there are different like I know that some people are just like, buy, whatever, like no matter what the thesis is, when you get in, just pay for as much time as you can, by 90 days, by 120 days. That did not work well for me as a trader, because I would compound those losses, because I would say like, oh, I paid for 90 days. So, this trade kind of violated where I wanted the stock to go. But since I have so much time, I'll just wait. And then it didn't recover. So I'd have to take like a much bigger loss than I wanted to take. So what I think that the caution that I think the most important thing and the most important approach is to have a rule for when you're going to get out, when price does not go in your favor. And Just as important, you need to have a rule for when you're going to get out when price does go in your favor, and to stick to those with fidelity. Always, the more time, especially if you're going to day trade a call, you don't really have to pay for time, really, because you're only planning on being in there for an hour or two. But if you're going to be, honestly, if you're going to be in for more than an hour or two, then even day trading you should pay, because if you're like, oh, I want to get in the AM and then get out in the PM, well, theta is going to tear through that thing on the day of expiration. So even then, probably want to add at least a week to it, just to help manage that theta.
I did the same thing. I was buying too much time, and I quit doing that because it also didn't work for me, because I got hopeful. Oh, well, it's not doing what I wanted to, or there would be a lot of money all at once. And then I think, well, it'll be more, but that's where I learned that I just got to set whatever my profit trigger is, and then not be greedy, and then get out. But that's a hard lesson to learn.
Yep. Yeah, for sure. I listen, this week I hung in some butterflies a little too long. I got this week, I really snatched defeat from the jaws of victory in my trading, I must say. Maybe towards the end, if we have some extra time, we'll kind of talk about that stuff. I did okay. But not as good as I could have. I'd actually like to pause here, because I have a number of more options chain slides that we can talk about and dissect. They're basically, I took screenshots from Tuesday. So remember, I took Monday's screenshot when we entered the trade, and then Tuesday's screenshot when price was a little bit beyond where the target would have been. But before we get into that, and so you can see right here at the bottom, we were trading at about $15 on SPY on that first now 3 days from expiration contract. Before I just go much deeper into this option chain, I'd actually like to pause again to allow some time for some dialogue. And just if anybody has questions, or if anybody has comments, anything of that nature that I can clear up.
This is Regina. Oh,
Go
go
ahead.
ahead, Regina.
In the case of SPY in particular, because I'm starting to do it, I'm finding I can't, at least in these times, I can't do anything more than a day. I just can't. I know it's like we're looking at what the chart says. Is it really feasible now? There was a time where maybe I'd go out a week or so. Now, though, I just can't trust SPY to stay normal, so to speak. Can we do longer? Are we still able to do longer periods of time? I mean, I'm bearish overall.
Listen, yeah, no, I hear your question. I think that there's a mix of technical analysis to think of, but also just personal psychology. And again, this is like come so naturally. The thing I love about studying with Suzanne is she teaches so much that we can all kind of find our own voice. So the way that I trade is going to be different than other people. The way that you trade is going to be different than other people. I agree with you. Like, I'm just going to try to go back to that daily chart. If I can make this thing go back, but like what you're saying, sorry, this is super awkward. Yeah, like this isn't exactly smooth price action. This is super, it's really jerky. So also this wick here makes no sense. I think this was just like somebody had a bad order in and the broker took advantage of it, you know? But like this wick is not there on SPX. This, you know, this was a massive gap that just accelerated from Monday to Tuesday. And then, you know, price just sort of stalled. It's very herky jerky right now. Buying and holding long calls at this time makes no sense to me. So if that's not if you don't want to hold for longer than a day and you're making money while you're day trading, there's a saying that says when the going gets tough, the tough day trade. So if that applies to you, then I think that you're doing right things.
Okay. 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 Thank you.
Absolutely.
I have one question regarding the option chain. Whenever I look at Delta, if you can go back and pull that up for me.
Yes, absolutely. Just why won't it let me? There we go. And, you know, I have like way too many. So
Anyone. So
Okay.
when I look at Delta, and I was expecting to hear this in the conversation. So if I get one at, say, I get a strike at 360.
Okay.
And that means that for every dollar that the underlying moves, my premium will move 54 cents, correct?
That's correct.
Okay, so I was looking to hear that from you, and you may have said it in another way, but I just wanted to verify that 54 cents relates to the movement of my premium.
Yes, that's absolutely correct. Can I add one detail to that?
Okay.
Okay. Notice that we also have gamma. So
Yes.
that's why when you look at this 360 strike, that's this 3 cent gamma is also affecting your deltas. So if that 360 moves, or rather if the underlying moves $1 higher from 360, all of a sudden your delta is no longer 54, it's 57. So that means the next movement, your premium is going to inflate by 57 cents instead of 54 cents.
Mm-hmm.
Then it's going to, right? So when you enter it, you just want to have an understanding of where gamma is, because if you get an explosive move in one direction or the other, the gamma is going to have an effect on your delta. But and then always, I think a great habit to get into, especially when you start looking at spreads or what have you, is check the delta on your position. Like you'll see that the delta kind of fluctuates, but you can always, as you're trying to decide how to manage, and you're looking at how much time you have on your contract, you can look at what that delta is telling you, because it will fluctuate around a little bit. But generally, when you get in, you can say, yeah, delta is going to change the cost of my contract based on the movement of the underlying. Mm-hmm. Does that help?
That helps. Now, looking at theta, so I get in and I buy it for $6.08. And if I hold it for, and I know that my delta is going to be 54, I always get confused with the theta, because theta impacts my premium. The longer I hold it, I lose 68 cents per day.
Right. I like to think of it in 24-hour periods. So when I execute my order and I get a fill, whatever theta is saying, 24 hours from now, my contract is going to be worth that's 68 cents less no matter what. So if price goes way up, I'm still going to lose that theta. Price goes way down, I'm still going to lose that theta. That's the way I like to think about theta when I enter it.
Okay.
But that was something that confused me as well, because it was like, okay, is it 68 cents an hour? Is it 68? No, it's 68 cents every 24 hours.
24 hours. Okay. But my delta, if there's a lot of volatility and my underlying is moving quite a bit, I'm gaining $54 every dollar it moves, but I'm losing 68 cents per day.
Right. So you
Okay.
can see, you know, you're almost giving up $1 of movement, or you're giving up a little bit more than $1 of movement. That's one way to look at it. And then Vega, I'm glad that you said that. For every percent increase over here to the right of the option chain is where we see volatility. So for every percent increase, that's how many cents is being added to the cost of the contract.
Okay. All right, thank you.
My pleasure. Then I think Kathy had a question as well, correct?
No, I was speaking.
Oh, I'm sorry. I apologize.
Mhm.
Thought we had one more. Okay.
So can I ask a quick question, going back to the theta question?
Yes.
Is the theta not moving with the change of the underlying as well?
It
Correct.
absolutely, yeah, it absolutely is. The reason that I like to and so if I think, okay, I enter this position and price moves in my favor, and then I can see, well, actually theta is working in my favor as well. Especially if I buy out in time, like if I buy, a month out, more than a month out, then that theta should be pretty stable, and it should maybe work in my favor a little bit as I get out of the money or deeper in the money. But if I'm really close to expiration, theta is going to ramp up anyway. It's going to, like, every day theta is going to get a little bit more and a little bit more. So I want to assume when I enter that contract to kind of think of theta on the higher end of the buffer as opposed to the lower end of the buffer. So that I can plan for, like, I don't want to wake up the next day and thinking that I would only have like a 54 theta and actually it's like a 72 theta. Like that would, especially if you're buying multiple contracts, that can add up. Does that make sense?
I guess I'm trying to follow the theta along the options change. So if you have a 360 strike and your trade thesis is price is going to go up because you're buying a call.
Yep.
Right. So if it goes against you, I know we all assume you buy a call, it's going to go up.
Yep.
Should you apply the $4 risk example? You're taking on that risk, right?
Correct.
Let's assume its price is going to come down and hit your stop.
Yep.
So isn't that theta moving as that price drops down?
I think I heard the question. Your voice faded a little. I think that what you're saying is, don't we see clearly theta is diminishing? Oops. Theta is diminishing a little bit and hurting us a little bit less as price drops down. And clearly, yes, you're correct. The reason that personally, when I enter a trade, I don't think about it that way is because if say it takes 2 or 3 days for price to go down, and cross my stop where I'm going to get out. I should assume that during that course of time, theta is growing on its own, because every day theta is going to get a little bit bigger. So just to help me with my risk management, I don't assume that theta is going to hurt me less, because I don't know. It may take me 3 or 4 days or a week to find out that my trade didn't work. Does that make sense, or is it like, because I know it sounds kind of strange.
Yeah, thank you.
Absolutely. I'm going to give a little bit of time for anybody who would like to come off mute, ask a question, or drop questions in the chat. Okay, I think that based off the questions I was receiving, I think that the points that I wanted to make, at least for today, in covering long call basics, I think I made them with the option chain. I don't think that I need to show every single strike that I thought I needed to. So I'm going to move forward to some of Suzanne's prepared slides, and then obviously at the end, if anybody has any additional questions that want to take us back into the chain and really dig into how price changed throughout the course of that trade, we can. But the questions that I've got make me think that people pretty much grasp or the points that I was trying to make. So we've talked about this, but just to drive the point home, when we enter a trade, we want to buy with enough time for price to make its move. So that means we're paying for that theta the way that we discussed, to make sure that it's not working against us too fast. We want to buy to open when volatility is low. And so this strategy this week wouldn't have worked because price just accelerated so fast on Monday. But oftentimes what we'll see is we'll have some morning volatility at 9:30 when the market's open. And then either usually around 10, honestly, to me, 10:30 to around noon, oftentimes we'll see a little bit of a retrace. And if we're able to watch the charts, that's a time where if we do have a bullish thesis, maybe we don't get in at the very lowest point of the day, but we get in at a point that's logical to us and that we can expect a higher price later. And we also get in at a point when volatility is not just incredibly high as it would be during the first hour, especially half hour of the market. A nuance Suzanne points out, Tuesdays when market volume is usually lower. Market volume is usually lower, and also, and this isn't as helpful now because we're not in a bullish environment. In a bullish environment, oftentimes if price is just moving higher and trending higher, Tuesday is a day where price takes a breather, and it's easier to get in at a discount. So just trying to look at sort of weekly ranges and trying to decide like when is price sort of going counter trend so that I can get in at a better price for my contract. We want to buy to open prior to earnings volatility or seasonal highs. And so what that means is there's later on in the Jade Lizard Room, there's actually some safe, relatively safe strategies for trading earnings, where really what you're trying to do is simply capitalize on the fact that you know volatility is going to expand moving towards earnings. So we will be talking about that later on in these seminars. And so that would be you're buying 4 to 6 weeks before earnings season begins, planning on volatility to expand. When volatility expands, you sell. And so that type of strategy actually happens. You enter before earnings and you even exit before earnings as well. It's a pretty cool idea. We'll talk about it later. Buy to open when IV rank and historical volatility are unseasonably low. And so these are indicators that you want to bring up to check to see where is volatility. If volatility is trading at a really low rate, you can kind of take advantage of that by buying and anticipating volatility to expand. Selling to close your position when you have reached your profit trigger, the predetermined dollar percentage move you aim to capture. So one of the fun things about options is if volatility works in your favor, you can sometimes hit your profit trigger before price actually hits your target. So you look at the cost of your contract, you think how much you want to make off of that contract, and actually set a buy to close limit for the cost of that contract hitting. And sometimes you'll actually get there, and even your contracts will inflate before your price even actually hits that target. The other option is obviously selling to close if price has made a strong move above relevant EMAs or support resistance. Oops. Oops, is that a question or did you come off mute on accident? And selling, selling to close when more than half the contracted time has passed to avoid theta decaying the entire value of your call. Oh, a question I'm seeing, will this be uploaded to the Jade Lizard Room? The Jade Lizard Room, I'm not sure, to be honest. I think because it's recorded, I think the answer to that is yes. And of course, Suzanne has recordings of this particular lesson, which is uploaded to the room. So if you're a member of the room or if you've paid for the room, you have access to this lesson. The only difference is obviously you're getting my take on it. And also I'm using examples that are more recent than the ones that she used when she recorded it. But if you're thinking about signing up for Jade Lizard, this lesson is absolutely there. So the replays are there. The truth of it, I think that we're recording with the intention of uploading it there, but I don't want to say for sure. That's a Suzanne question. She might see this recording and say, oh, not want to do it. Or hopefully she does want to do it. I hope she wants to do it. I want to briefly explain this slide because it blew my mind the first time I saw it. Try to avoid the curving lines. Like just try to see the underlying cross and diagonal above it. That diagonal represents if you're trading shares. There is a smooth linear motion to trading shares. The curving line is teaching us how options prices, you just have to be ready and aware for the fluctuation in options prices. And so again, just one of the things that I'm always so impressed with in Suzanne's trading is she has such a mastery over the options Greeks and finding ways to exploit the curves that happen beyond straight linear price movement, and finding ways, all these creative strategies to put profits in our pockets as traders. This is I really love this graphic for the risk profile of a long call. And just what we always see is this typical, the capped loss is the cost of the contract that you bought. And then the possibility for exponential growth if price moves in your favor. What I love is actually this little triangle underneath it, which is reminding us that theta is going to be chipping away more and more and more as time goes on. So every day, theta is taking cost out of our position. And this is just another way to look at the same idea. It's it's the same graph. It's just a little bit longer visual depiction. And also these slides are actually uploaded on Jade Lizard as well. And so this is the long position moneyness chart. And it's just the idea that obviously here we have our at the money call. It's showing how as we get deeper in the money, delta is growing. But obviously, if we get further and further from the money, we are approaching max loss, because not only is time working against us, but delta has worked against us so far that our contract premium is really eaten away. So in conclusion, we're trying to take advantage of a strong increase in price of the relevant underlying. Profitability is to enter at the money where delta and gamma are likely to increase. You can also enter slightly out of the money to lower cost of entry. There's some really slick traders in our community who find ways to find, cheap, out of the money, like way above current price options, and just expect price to drive up towards them. And so they're getting a massive bang for their buck when they do that, because they're buying out of the money so that the premium is really low, and it just gets inflated because of their anticipatory skills. Trying to enter out of the money to both lower cost of entry and the number of contracts. Traders almost always close in the money options before expiration. Somehow I missed this slide. I don't know how. It's really silly. But long in the money calls will be assigned at expiration, and you will find yourself holding 100 shares of the underlying the next day. Or if you're like me, the next Monday, and you'll get assigned you'll find out Saturday morning when you're visiting extended family. And so you'll be very stressed, and it's like, I wanted to call Thinkorswim so bad, but I was like visiting grandma, so I couldn't. So I was just having to hold it all in for a while. And again, it all worked out in my favor, but I wouldn't wish that stress on anyone. I was like really hard on myself during that time. So just know, if you have an in the money call, regardless of if it was a butterfly or a whatever that you were trading, it will still be assigned if you are silly like I was that day. Everybody, it was a real joy to do this. And I appreciate everybody who showed up and listened, everybody who had questions, everybody who had comments. It's an honor to serve this community. I have confidence in myself as a trader because of the way that this community supports each other. I have confidence in myself as a trader because of just how much care Suzanne takes to make sure that every question gets answered. I remember when I was new to this community, I felt like every question I asked was silly because everybody knew so much more than me. And I realized that everyone in this community just wanted to help each other. And so I never at any point, once I started asking questions, I realized that there was nothing to be afraid of or nothing to be intimidated by. And it just helped me learn and grow so much. So really appreciate everyone's time. Thank you all. And I will stick around for a few minutes if anybody else wants to throw some questions into the chat or anything of that nature.
Jay,
Come on, Jay.
okay, I have a question on volatility and
Okay.
buying. Oh God, I lost my question. Okay. When is it considered, when we're thinking of you want to buy when volatility is quote unquote low, are we thinking about the VIX, what the VIX is, whether is there a particular number when we think about it slow? Are we waiting maybe for, when price maybe to settle a little bit? When
Yeah.
we can consider it low volatility?
I'm going to try to explain this with my option chain slide. I would like to bring up my Thinkorswim, but what I find is sometimes when I bring up my Thinkorswim on Zoom, it just doesn't load. And because it would be easier if I could kind of bring up some indicators. And actually, in Suzanne's original presentation, she talks a little bit more about IV rank, and she teaches that indicator. But what I want to draw your attention to is you can kind of watch IV in two separate ways on the option chain. Like for one, you can look on the right side and just notice how, different contracts are actually being affected by IV differently. So just be aware of that. Sometimes if I notice, like, for example, I'm shopping and I want to get I'm just picking a place where there's a disparity. So I was looking at maybe 18 or 21 days out. Let's just pretend I was. Well, I'd probably buy at 21 days out where I know I'm paying a little bit less for volatility right there. So I would look at that. Another thing to notice is if you're in Thinkorswim and you click this arrow by the option chain, then all of the different time selections collapse, and you'll see today's option statistics, and you'll get a view for, like, right now where that IV is trading at. So if you're thinking about or planning to trade an option, you should sort of, as you're charting it and as you're watching it over a couple of days or weeks while you're coming up with that plan, start to notice if it's spiking in IV and how it's doing. So sometimes it is in relationship to the VIX, but also individual options or individual underlyings are going to fluctuate sometimes. And so it's good to kind of just see that. But I think that a good rule of thumb is unless you have an incredible conviction about where price is going, like prices is really going to rocket, like unless you're really concerned about or convinced about that, then you don't want to buy right at the market's open, because absolutely you're going to be paying a ton for IV. And so one of the ways that I learned that was, for a while I was trading iron condors, and I would enter my iron condors immediately at the market open, because an iron condor, you're profiting by selling options, not by buying options. So I wanted to sell as much volatility as I could. So I would just the instant the market opened, I wanted to be selling those iron condors to capitalize on the fact that I knew volatility would be high. So, but I also think that generally it's something you want to have an idea about. It's not something that you want to stress yourself like into insanity. If the chart is telling you and your technicals are telling you that it's a good time to buy an option, then you should probably buy that option, especially if it's not right at the market's open, because it's rare that volatility is just gonna just out of the blue sky, just like drop out of an option for no reason. Like that doesn't make sense. You just want to avoid the times when it's going to be super high and you don't have a way to account for that.
Okay, thank you.
Sure.
Should I raise my hand to ask a question?
No, go ahead.
My question is, say that I wanted to buy a long call 45 days out. Is it possible that sometime soon after I buy that I'll know that it's not going to work out no matter what? Does that happen?
Yeah. Yeah, for sure. I think that we pay for time for a couple reasons. Like, I think that the big reasons that we pay for time are we want to give price an opportunity to travel. So we want to kind of know the average true range of our price. Or our underlying, we want to know how long we should reasonably expect it to take to get to our target. But also, it gives us time. I think what we don't want to do is just let it sit around, clearly not do what we want it to do, and then just say like, oh, well, I paid for time, so hopefully magically it'll fix it. No, just exit that trade. But say you enter a trade, you paid for time, and then you get hit with a gap down, and all of a sudden it's actually like you're looking at a loss that's bigger than what you wanted to invest. At least you can take a minute or 15 or whatever and think like, does this have a reasonable chance of like at least recovering to the range in the chart that I wanted to take the loss at? You can ask yourself that. Whereas if you don't pay for enough time and you get hit with a gap, and you just know like there's no way for this to recover. That's not me advocating for saying like, oh, price moved against you, and then you just hang on for dear life for no reason. I don't want to advocate for that at all. Not at all. I think that keeping losses small is paramount of importance. But if keeping losses small is paramount of importance, and you get hit with a vicious gap down, and you see something in the chart that says, you know what, there's reason for me to think this can recover, and I have some time, then you might choose to do that. And so I know that's like a little bit long-winded, but hopefully that helps.
That wasn't long-winded at all, and that's a perfect answer.
Okay.
I was hoping that buying a bunch of time would make things safer, but it doesn't.
No, it doesn't. It just makes it, especially not in this market, because we're really not in bullish conditions right now. So we want to be really careful when we buy calls or puts. Just be careful always. So to select the strike before gamma explodes, like Suzanne does. I think that first of all, the way to think about that is Suzanne doesn't like to buy super deep in the money when she starts out, right? So let me get back to the option chain, and hopefully I have something that demonstrates this. If you buy, for example, way up here where delta is already at 84, then if your contract goes in the money, deeper in the money by $10, $13, that delta doesn't have a whole lot of room to expand. It can only make it to 84 cents, can only make it up to $1 before gamma stops. Gamma is just not going to help anymore because it's only going, the limit that it's going to grow is $1 representing the 100 shares. However, if you're closer to at the money, then you have quite a ways to go if price keeps on going in your favor. And then it's even more so if you buy, say, a little bit out of the money, then you know, at first you're paying, you know, you're getting like a 42-cent delta or what have you. As price goes deeper and deeper in your favor, as that option goes deeper and deeper in the money, you're going to get that gamma in your benefit. Now, Suzanne has more advanced strategies for sort of seeing where brokers have to sort of hedge, and then there's a gamma squeeze, and you'll see her talk about that in the Telegram groups at times. But I'm not great at trading that way, to be honest, yet. That stuff is still a challenge for me. So I don't want to try to explain it too much, because I will mess it up. But it is something that she's really great at anticipating. But I would say the easy way to think about it is, if price is going to have an explosive move, sometimes, or if you have a strong thesis that price is going to have an explosive move, you may choose to say buy 3 or 4 contracts at a smaller premium than one really large premium contract, because you're saying like, wow, if price is going to really rocket in my direction, or that's what my thesis is telling me, then I can take the same capital. Say I want to invest $1,000 in this trade. Not that I want to take an $1,000 loss, but say that like I want to partition $1,000 of my trading account to this trade. You might choose to buy 3 contracts for $3 that have a 40-cent delta, as opposed to 1 contract that has an 80-cent delta, because you know that you think price is gonna move in your direction, and then all of a sudden you have way more deltas at your disposal because gamma has kicked in so hard on those original small contracts. Does that, Kev, does that make sense? Cool. Let's stick around if anybody else has comments or questions. Absolutely, Kev. All right, well, I think that for tonight, we're gonna call it a night. It was a real pleasure. Thank you to everybody. Vicky, thank you for helping me out. Thank you everybody for your positivity. I really appreciate it. Everybody have a beautiful night, and I'll see you next week, and I'll see you on Telegram.
Thanks, Jay. Take care.
Thanks, Jay.
Thank you,
Thank
Jay.
you. Thanks. All right, good night, everybody.
Thanks, Jay.